This is part 3 of a 3-part video on purchasing a home. In this video, I'm going to discuss what you should consider when choosing between a 15 or 30-year home loan and show you how to calculate if refinancing makes sense. Hey everyone, this is Michael Tortorich and thanks for tuning in. Just a quick note in the video before we get started. These videos are designed to complement my book, Running the Numbers, a step-by-step guide to life's major financial decisions. Each video corresponds to a chapter or section in the book, and the idea is to review the chapters and use these videos as a platform to add some additional color around the examples where it just wasn't practical to do in the book. So, to check out the book or additional videos, please visit my website at michaeltortorichfinance.com, and there's also a link to the website and the book in the description below. So, in part 1 of this video, I explained what a mortgage is, and then showed you how to calculate the payments for some of the common types of home loans. In part 2, we looked past just the loan payment and looked more holistically at all of the costs associated with owning a home. In this last section, I want to walk you through the main considerations when choosing between a 15 or 30-year loan, and then show you how to calculate if refinancing is a good choice or not. So, it's very typical when you apply for a home loan, the bank is going to present you with the options for a 15 or a 30-year amortizing loan. And these are by no means your only options, but a 15 and a 30-year are by far the most common. And there are really two main things to consider when choosing between these options, the affordability and the opportunity cost. So let's start with affordability. The payments on a 15-year loan will always be higher because you're paying back the principal over a shorter period of time, 15 versus 30 years. Now, in the previous video, I gave a framework to evaluate the affordability of a home, but the reality is that affordability is going to be different for everyone, and that's going to depend on your situation, what you deem reasonable, etc. But in order to help with deciding if a 15 or 30-year loan is right for you, what I want to do is take a more in-depth look and compare some of the trade-offs of the two loans. So, as I mentioned, a 15-year note will always have a higher monthly payment, and that's because you're paying back the loan over a shorter period of time. However, because the loan term is shorter, a 15-year note will always have a lower interest rate. And so, why does a 15-year loan have a lower interest rate? Well, if you remember back to Chapter 1, Time Value of Money, an interest rate has two components. It has an inflation and a risk component. And because the lender, in other words the bank, gets paid back 15 years earlier than what they would with a 30-year loan, they incur less risk. And also because the loan is shorter by 15 years, there's less inflation. So the increase in monthly payment due to the shorter payback period will always be partly offset by a lower interest rate. So now I want to jump to Excel and compare the monthly payments for a 15 versus a 30-year loan. And this Excel can be found on my website, michaeltortorichfinance.com. And here you can see the spreadsheet I've set up, and we're on the 15 versus 30-year loan tab. And starting in the top left of the tab, you can see the assumptions. And you'll notice that there are yellow highlighted cells, and these denote input cells. On every tab, there's an assumption section, and by changing any of the values in the yellow highlighted input cells, the calculations will update and flow through to the rest of the formulas. So, for the 30-year amortizing loan, you'll notice that we use the same assumptions we used previously in parts 1 and 2 of the video. We have a home purchase price of $400,000, a 20% down payment, 3% interest rate, and 360 periods. And then here in cell B11, you can see I'm using the PMT formula to calculate the monthly payments. And if you need a refresher on how to calculate an amortizing loan payment, please see the link above and reference back to part 1 of the video where I go over how to use the PMT formula in much more detail. So you can see the monthly payment for the 30-year loan is $1,349. Now, moving to the 15-year amortizing loan, the only difference in the assumptions is a lower interest rate of 2.5%, and then the term is reduced to 180 periods. And you can see I'm using the PMT formula again, and then based on the above assumptions, your monthly fixed payment of principal and interest will be $2,134 for the 15-year loan. And this is $785 per month more than the 30-year loan. However, while the monthly payments are more expensive, the trade-off is that you'll actually pay less interest over the life of the 15-year versus the 30-year loan. And if we add up the interest paid each period for the 30-year loan, you'll pay $165,688, and then for the 15-year loan, you'll pay $64,071. So by making higher payments over a shorter period of time, you actually save $101,617 of interest. Now, just as a quick aside, you don't have to do all these calculations to figure out how much interest you'll pay over the life of the loan. Excel actually has a built-in cumulative interest formula that you can quickly plug in and get the total interest payments for any loan. So let's take a quick look at how to do that, and I'll use the 30-year loan as an example. And to calculate the total interest paid, we're going to use the Excel CUMIPMT function, and it takes the following inputs. First is the rate, and this is the periodic interest rate, which is 0.25%. Next is the NPER, which is the number of periods of 360. Next is the present value of the loan, which is $320,000. Next, it asks you for the start period of the loan, which is 1 for the first period, and then the end period, which is period 360, and that's when the loan will be paid off. And then lastly, you need to input the type. And as always, we assume the loan is paid at the end of the month unless explicitly told otherwise, and so we'll input as 0 for the end of the month, and that gives us a total interest paid of $165,688. And this is the same amount that we got from doing the calculations manually above. So, just to wrap up this section, while affordability may ultimately dictate whether you can choose the 30-year or you have to go with the 15-year loan, the important thing to remember is the trade-off, that for lower monthly payments of the 30-year loan, you'll actually end up paying more interest over the lifetime of the loan versus that 15-year. So now that we've talked about affordability and the trade-offs, let's move on to opportunity cost. So if you can afford either the 15 or the 30-year loan, then the other factor to consider is the opportunity cost. And what I mean by that is that if you can afford both loans, then you should evaluate your options for what else you could do with the extra money that you'd have to pay for that 15-year versus the 30-year note. So let me clarify a bit further what I mean by that. So let's continue with the previous example and assume you're choosing between a 15-year note that's going to cost $2,134 every month, or a 30-year note that'll cost $1,349 a month. Let's also assume that you have $2,134 available, and regardless of which loan you go with, you're either going to pay to the bank the entire $2,134 or pay the lower amount for the 30-year and then invest the difference. And the numbers will look as follows. If you go for the 30-year loan, you'll have $2,134 available, you'll make a loan payment of $1,349 and then have $785 left over, and you'll invest that money every month for 30 years. If you go with the 15-year loan, again, you'll have $2,134 available, you'll make the loan payments of $2,134 for the first 15 years, and then for the last 15 years, you'll invest that amount every month. And to compare which option is better, we can look at the respective future values of what the invested amounts will end up being for both options after 30 years. So let's jump back to Excel and take a look at those calculations. And again, this Excel can be found on my website, michaeltorrichfinance.com, and here you can see we're on the Opportunity Cost of 15-Year Loan tab. So starting in the top left of the tab, you can see the assumptions as we went through previously, and below that, I've added some additional assumptions and calculations. So first, we're going to assume you can get a 5% annual percentage rate return on any money invested. And we're also going to assume that it's compounded monthly. So your periodic, in other words, your monthly interest rate is going to be 0.42%. So let's start with the 30-year option. And as I mentioned, we're going to invest the difference between the 30 and the 15-year loan. And we know that that's $785 a month. So now we can use the future value function to see if we invested that $785 every month at a 5% return, what would the value be after 30 years? So let's input that here in cell B29, and the inputs are as follows. First, you type in the equal sign, and then FV for the future value function, then an open parentheses, and the first thing that Excel is going to ask you for is the rate. And this is the monthly rate. And again, the reason we use monthly is because we're going to be investing this money every month. And we know the monthly rate is simply 5% divided by 12, which is 0.42%. Next is the NPER, and this is the number of periods, which is 360, and that's the same number of periods as the 30-year home loan. Next is the PMT, or the payment, and this is the amount that you're going to be investing every month, and this is $785. And it's important to note that you need to enter this in as a negative, and you enter this in as a negative in Excel because this means that you are contributing money, in other words, investing money every month. Next is the PV, or present value, and that's 0 because on day 1 you have nothing invested. And then lastly is the type, and that's 0 as well to denote making the investments at the end of the month. So you hit enter, and you can see at the end of 30 years your investment will have grown to $652,984. So now let's take a look at the future value if you go with the 15-year option and you invest the $2,134 every month after 15 years when the house is paid off. And again, we're going to use the Excel FV, or future value function, and the inputs are as follows. The rate is again going to be 0.42%. The NPER is 180, and this represents the last 15 years of the 30 years. The PMT, or payment, is now going to be a negative $2,134. And the reason, again, the payment is different is because we're assuming the full amount is now available to invest because we're investing now that the loan has been paid off. The PV, or present value, is 0 because, again, on day 1 you have nothing invested. And lastly, the type is also 0 because you'll be making the investments at the end of the month. So now, again, you hit enter, and you can see that at the end of 30 years, if you choose the 15-year loan option and invest the loan amount during the last 15 years, in other words, once the house is paid off, you'll end up with only $570,321. So you're actually better off taking the 30-year loan at a slightly higher interest rate because by investing the difference, you'll actually end up with more money at the end of 30 years. Now, if you're wondering why you end up better off with a 30-year loan, let me explain. The annual rate on the 30-year loan is 3%, but because you can invest the $785 a month at a 5% interest rate, you get to keep the additional 2%. And because you start investing immediately with the 30-year loan, your investments have more time to compound, and you ultimately end up with a higher value. So the primary factors driving the future value of the two options are the interest rate spread, in other words, the difference between the rates on the 15 and the 30-year loan, and the assumed investment return. And in this example, the difference between the 30-year and the 15-year loan is pretty small. It's only about 0.5%. But as the 30-year loan interest rate becomes more expensive relative to the 15-year rate, the 30-year loan will become relatively less attractive. And for the investment return, as the spread between the investment return and the interest rate on the loan widens, in other words, as the investment return increases relative to the rate, the 30-year again becomes more attractive because you can start investing sooner and your money has longer to compound. So in summary, it's really a combination of the difference in interest rates and the assumed investment return that's going to determine which loan is going to leave you better off financially. And the key takeaway here is not that one loan is necessarily better than the other, but it's the framework to run the numbers to evaluate which loan is better for you. Now, the next topic I want to touch on is if you should pay your house off early or not. So let me give you a hypothetical situation. Let's say you took out a 30-year loan on your primary residence and a few years have gone by and now you have some extra money to make additional monthly payments. Now, from a purely financial perspective, if you can invest the extra money to generate a higher return than the interest rate you're paying on your loan, you should not pay off the house early and you should invest that extra money. However, you have to remember that investment returns aren't 100% guaranteed. And in particular for your primary residence, you may not want to take the market risk for an extra percent or two of return. Now, let's continue with this hypothetical example and assume you ultimately decide not to invest the money. Your peace of mind is most important and you want to make the extra payments so that you can pay off your house as soon as possible. Now, when making any extra payments on your loan, it's extremely important to make sure the extra amount is applied to principal. Now, typically, this is as simple as checking a box on the bank's website, and a lot of banks will even automatically apply any additional amount you pay to principal. However, banks' policies are all different, and you need to make sure you understand the process so that any additional amount you pay goes to the principal. And what I want to do now is actually take you to my bank's website and show you an example of how to do this. So I have a home loan with Chase Bank, and if I go to make my monthly payment, you can see it gives me 3 options. And if I click minimum payment amount, and this is just my monthly payment, you can see that extra options appear for any additional amount that I want to pay. And as you can see here at the bottom, I can apply the additional payment to principal or escrow. And if you select escrow, the bank will actually hold the money for you, and any extra payment you make will not be applied to your outstanding principal. And there are times when you would want to put money in an escrow account. For example, if your bank is paying the property taxes or the insurance for you at the end of the year. But if you intend for the money to be applied to the principal of your loan, then you need to make sure you select Apply to Principal. Now, all banks' websites aren't going to be exactly the same as mine, but the point is just to show you that you need to pay attention and make sure that you make the right selection to ensure that any extra payment you make goes where intended. Now I want to move on to the topic of refinancing. So first of all, what is refinancing? Well, this involves taking out a new loan at a lower interest rate to pay off an existing loan at a higher interest rate. And what I want to do here is show you how to evaluate if refinancing makes sense or not. Now, the first thing to note about refinancing is that taking out any new loan involves fees. So it's not just as simple as saying, oh, my new interest rate is going to be lower, so I should refinance, because the fees are going to be added to the principal amount of the new loan. So any savings you get from that lower interest rate are always going to be partly eroded by the addition of those fees. And the 2 criteria that we want to look at to evaluate whether refinancing makes sense or not are the break-even number of periods you need to hold the home and then the overall savings. So let me explain a little bit more about both these criteria. So as I mentioned before, whenever you refinance, the principal amount of your loan goes up slightly because of fees, but your monthly payments go down. And assuming you continue to make the same payments as before you refinanced, you'll now be paying extra towards the principal every month. And the break-even number of periods tells you how many payments you need to make until you pay down the additional fees that were added onto your loan. And then the overall savings is just how much less you'll spend in total after refinancing than you would have spent if you'd kept the original loan. And again, I want to reiterate that for both of these criteria, we assume that after you refinance, you continue to make the same payments as before. And if you're refinancing because you can't afford your monthly payments anymore, then this analysis isn't really applicable. I mean, if you can't afford your monthly payments, then refinancing isn't a choice, it's a necessity, and the only real criteria is if you can get a low enough monthly payment so that you can continue to live in your home, which again, that's not the assumption of this exercise. So now let's look at an example of the break-even analysis, and we're going to run some numbers and see how this works. And to do this, we'll need to make a few assumptions. We're going to assume you took out a loan for your current home 5 years ago. Your purchase price was $400,000 and you put 20% down, so your loan amount is $320,000. Your interest rate is 5% and it's a 30-year loan. Your current monthly payments are $1,718, and after 5 years, or 60 periods, rates have dropped significantly and you can now get a new 30-year loan at 2%. And then the fees for any new loan are going to be 3% of the principal amount. And so now that we've laid out the assumptions, let's jump to Excel and we're going to actually run some numbers. And this Excel can be found on my website, michaeltodorichfinance.com, and we're on the Refinance After 5-Year tab. And starting on the top left, you can see the inputs for the original loan that we used to calculate the current monthly payments of $1,718. And you can see that here in cell B11. And if you need a refresher on how to calculate monthly payments of an amortizing loan, please see the link above and reference back to part 1 of this video where I review the amortizing loan payment calculations in much more detail. So if we move down, you can see I have the refinancing loan assumptions that we just reviewed. So you can see the periods remaining on the original loan are 300, and as 5 years have gone by, we get that by subtracting 60 periods from the original loan term of 360. Next, we have the current interest rate of 2%, and then below that, the periodic or monthly interest rate of 0.17. Then we have the number of periods of the new loan, and because it's a 30-year, that's going to be 360 periods. The future value of the loan is going to be 0 because we're going to pay it off, and then we assume end of month payment, so we have a 0 here. And the first thing we need to do is determine what the outstanding principal is. In other words, how much we still owe on the existing loan after 5 years. And to do this, we can use the PV or present value function in Excel. So the first input the present value function is going to ask you for is the periodic rate. And it's important to note that you need to input the periodic rate from the existing loan, which is 0.42%. Next, it's going to ask you for the NPER, and this is the number of periods left on the existing loan. And as 5 years have gone by, there are 300 periods left, so we'll type in 300 for the periods. Next is the payment, and this is just the monthly payment for the existing loan, which is a negative $1,718, and again, it's a minus because that's the amount you're paying every month. Next is the FV, or the future value, which is 0. And then lastly, the type is going to be 0 as well, because we always assume we're paying the loan at the end of the month. Lastly, we close out the formula by adding another parentheses, hit enter, and you can see that Excel calculates the remaining balance of the existing loan of $293,852. Now, in addition to the current outstanding principal of $293,852, the bank is also going to charge you fees of 3% on that outstanding balance. So we need to multiply the current balance of $293,852 by 3%, which gives us a loan fee of $8,816. So next, we add that loan fee to the existing principal for a new loan amount of $302,668. So to refinance your outstanding principal on your existing loan, you'll actually have to borrow a slightly higher amount of $302,668. So now that we know the new loan amount, we can use the PMT, or the payment formula, to calculate the new loan payment. And so the first thing we need to do is input the periodic rate. And we've already calculated this above, and it's 0.17%, or 0.0017 in decimal form. Next, it's going to ask you for the NPER, and this is the number of periods for the new loan, which is 360. Next is the present value of the loan, and as we just calculated, it's $302,668. Next is the FV, or future value, and this is 0. And then lastly is the type, which is 0 as well, because the loan is going to be paid at the end of the month. So we close out that formula, and the new loan payment is going to be $1,119 per month, or $599 per month cheaper than the previous loan. So assuming you continue to pay the original loan amount of $1,718 every month, an additional $599 is going to go to pay down the principal of the loan. So if we take a look at the detailed monthly breakdown of each loan payment, which you can see over here to the right, we have the beginning balance each month, the interest, principal, additional payment, and then the total amount paid of $1,718. And this is the same amount that you were paying every month on the original loan. And then you have the end of period balance. And if we compare the outstanding balance on the new loan with what the outstanding balance of the original loan would have been, which you can see here on row 22, we can see how much better or worse off you'd be at the end of each period. And I've done that calculation for you here in row 23. So if we take a look at the end of period 1 as an example, the outstanding balance on the new loan is $301,454. But if you had kept the original loan, the equivalent period would be period 61, and you would owe only $293,358. So after your first loan payment of the new loan, you actually owe $8,096 more than if you just kept the original loan. Now, just as an aside, I've put the equivalent amount that you would owe on the original loan here in row 22, and that's just to make it easier for you to see. But if you want to see the details for the original loan, you can reference this top section where I have that broken out as well. Now, as you move forward each month, because you're paying an extra $599 to principal, the difference starts to burn off, and as you can see, in period 13, the outstanding balance becomes less for the new loan. So what does this tell you? Well, this tells you that you need to hold the house for at least 13 months to make refinancing worth it. In other words, it takes 13 months to recoup the refinancing costs. And if you sell the house sooner than 13 months after you refinance, well, you'll actually owe more than if you had done nothing. Now, assuming you continue to hold the house indefinitely and continue to make the same monthly payment of $1,718, the additional $599 will continue to pay down the principal rather than going to interest, and the loan will be paid off, if we scroll over here to the right a bit, after 209 periods. Now, the next question is, well, how much will you save in total if you refinance? And again, I want to note that to do this calculation, we assume you continue to make the original payments of $1,718 and you fully pay off the house. And to calculate the overall savings, we simply compare the total amount you have left to pay for the original 30-year loan and the total amount you'll pay for the new loan. So first, let's calculate the remaining amount for the original loan. And this is simply your original payment of $1,718 times 300. In other words, the number of payments left, and that's going to be $515,400. And as I just showed, it's only going to take 209 more periods to pay off the house with the new loan, so we'll simply multiply the $1,718 times 209, and we get $359,062. So if we take the difference of what you would have paid versus what you'll pay with the new loan, you save just under $157,000. Now, just as a quick aside, because the additional principal payments have been made on the new loan, in period 209, the final payment is actually only $1,311. The full payment of $1,718 isn't required in that last month because you've been paying the extra $599 every month. So if you want to be exact, you would need to adjust for that amount, but the point is, not only do you pay the house off sooner, but you also save almost $157,000. So this takes us to the end of Chapter 8, Part 3, and this has by far been the most challenging topic that I cover in the book and in the videos. And not only because of all the calculations involved, but because of the multitude of variables as well. And while you should definitely try to understand all these calculations, I recommend that you familiarize yourself with the Excel tabs that we covered and try inputting your specific data into the yellow highlighted cells and test out some of the different scenarios that apply to you. And what this will do is it'll allow you to focus less on the detailed calculations and more on understanding the key outputs you need to evaluate all the decisions around purchasing a home, refinancing, etc. So if you like the videos, please don't forget to subscribe and hit the like button. And also stay tuned for my next video on Chapter 9, where I'll review some of the financial considerations around having kids. And lastly, for more information on the book or additional videos, you can check out the links in the description below or my website at michaeltortorichfinance.com. Thanks for watching.